Hello and welcome. You are joining us live once again on the Investor Lab, the home for passionate people seeking a life of freedom, choice, and abundance. And by golly, have we got some good stuff to get into today. Gabby, how are you?
I'm fabulous. Goose, how are you?
Good. I'll be honest. I'm a little tired today. My calories are low.
Oh, no.
People who have been watching this for a little while might have seen my face shrink a little over the last few months.
That's been shrinking a little
bit.
Mm-hmm.
Yeah. But that's okay. I'm good. I'm excited. We've got a lot of stuff to talk about today, so I'm excited to get stuck into it because I think there's a lot of noise out there at the moment. Lots of people asking lots of different questions. Matthew Pitt, good morning. Good to see you. Guys, let us know if you are here live. Good to see you live in the chat. If you are here, if you're not joining us live, please leave us a comment on YouTube. By the way, Gabby, I noticed people did leave us comments on YouTube last time and we haven't got back to them. And that's not pointed at you. I also did not get back to them.
Sorry. Yeah.
No.
Yeah.
It's also me. So we need to get better.
We will do better. We'll do better.
But we do try and deliver a lot of value. Hopefully you get value out of this. And if you do like this episode, if you like us showing up to give you free value and try and add value to your lives, then please let the algorithm gods know by giving us a little like, maybe even subscribing if you haven't done so already. Or in fact, you know what would be even better than any of that, because what matters more is impact, is if you could share this episode, if you think it's useful, if you could share this with someone that you care about, someone who's going to get value out of the stuff we talk about today. Because there is a lot of noise in the market right now about so many different things, about so much stuff.
Yeah.
And it causes people to freeze, which is fair enough, by the way. You know, programmatically, we're designed for loss avoidance. You know, like if you go back to, prehistorical, if we go back to Neanderthal times or whatever, right? Like, when we're running around hunting and foraging in the wilderness, if there was a noise in a bush, right? If that was something that was going to kill you, you would benefit from running away from it. If it was something that wasn't going to kill you and you ran away from it, well, you still wouldn't die, right? So we're programmatically designed to hear noises in the bushes and then either, freeze, fight, or flee, basically. And so that tends to happen quite a lot at the moment. And in fact, I think that's also why, geez, not even started and I'm already going tangential. I think this is also why you see much more of a prevalence of people acting in an inflammatory way online. I have noticed personally, and I don't really have a lot of time for it, that people are they're quicker to assume bad intent, quicker to attack people online, quicker to see the worst potential outcome in people. And I think that that's a symptom of the kind of like freeze, fight, or flee kind of scenario when there's so much stimulus happening and people feel really, really uncertain. Some people get frozen in paralysis and they do nothing. Some people see it as an opportunity and they rise up to it and they want to take, grab the bull by the horns. In fact, I was talking to a friend yesterday, and he was saying that he doesn't know what's going to happen. We were talking about the degree of uncertainty of the future at the moment, which is super interesting. And we were talking about the idea of like, how do you play it? Do you play offense or do you play defense? And he said, and by the way, this guy, I was actually kind of a little bit surprised because this guy's quite, I would say, like risk averse in a sense. He's always played a pretty safe bat, very successful nonetheless. But he basically said, no, I'm going all in because if the ship's going down, I want to be right on the front. I'm like, well, that's super interesting. And all in the context of like not playing defense, really sinking his teeth in, trying to find the opportunities, like going hard, particularly in an investment context. But then you've also got the people who, so you got, freeze, fight, or flee. And then you got the people who want to just kind of attack the world and achieve nothing. And I think that's symptomatic of where we are today. So my hope is that some of the stuff we're going to talk about today is going to help to strip away some of that noise, give people more clarity, so they can act with more certainty and act in a way that is more conducive to them achieving a life of freedom, choice, and abundance, which is at the end of the day what it's all about.
Nice. Yeah. I think with a lot of people, it's there's a lot of skepticism, and I think that's why it comes through online in that particular way. It's like people are really distrusting of just a lot of stuff at the moment, and that can show up in angry comment threads. It can show up in people being a little more snappy with each other. And I think obviously it's a very unusual and kind of tense time right now, but it's like there's always things that people have to be skeptical about anyway. Like there's always been, particularly in the concept of like, is now a good time to be building my wealth? There's always things that people can have doubts about and can always use as a, I don't want to say it's just a story, because it's more than just a story, but it's like this surrounding narrative in the way that you approach the world of, I can't do that yet because of X external thing. And so it's obviously much more prevalent at the moment, but I think it's important to be aware of because it's always kind of lingering there anyway.
Yeah, I mean, it's hard because you're right. There's always been an excuse, right? There's always been an excuse that you could find to sit on the sidelines and do nothing. There's always been that stuff. I would say though that right now the velocity of changes and stimulus has increased, and so risk management is important, and so. But people have a tendency to kind of like over risk manage, and that puts them into kind of like the freeze and flee kind of buckets more so, because that it feels safer in the moment. But realistically, it's actually not necessarily that there's more risk. It's just that there's more noise at the moment. So why don't we get stuck into it? Why don't we start chipping away through some of these things? Because we've got 6 questions. And I'm going to be shocked if we sit through 6 questions today.
I don't know if I've ever gotten through more than like 3, but we'll see.
Let's see how we go.
So we put these questions together because we talk about a lot on this show, right? We talk about property investing. We talk about different types of asset classes. We talk about the economy. We talk about AI. We talk about a lot of different things that are changing and are super relevant in the world. We pull these questions together because it's kind of like the summary of all of the things that have been changing, and probably the questions that people have on their minds of, what is your opinion? Like, what is actually happening? Because we only have capacity to do this so often. So a lot changes in between episodes, and a lot changes, and there's just so many things that we want to be able to talk about and share. So, Goose, I'm going to start with like a very property-centric question. Is that cool?
Good. Yeah, totally fine. Yeah.
Great.
Yeah.
Great. Because I think I see it particularly relevant with our team at Dashdot, and questions coming through from clients is around CGT. So there's discussions at the moment about CGT discounts potentially looking to change. How do you think that this changes your perspective or our perspective on property investing and portfolio strategy? And like, does it change anything in your opinion?
It's a really good question. And going back to sort of what we were talking about a moment ago, people hear or they experience stimulus and they treat it as fact, right? They think that they hear a noise in a bush and they immediately think it's a tiger, right? What the CGT situation is, it's a proposed change. Now, I don't know about you, but the amount of things that governments propose to do and then never actually do is like, I think is astronomical, right? The amount of proposals that go nowhere in government significantly outweighs the proposals that go anywhere. And so it's a bit of a sensitive topic because so much of Australia's wealth is in real estate. So necessarily people are like, oh my God, is this going to affect my my personal wealth position? What does this mean for me? And you know, Australia is such a property loving nation that it really becomes this I think over exaggerated potential. Now, I don't know, maybe it's going to get passed, right? So is it reasonable to ask, well, what would we do if these changes came into play? Yeah, I think it's a reasonable question to ask. Like to not even consider what you would do in that scenario, I think is foolish, to be honest. I think you should consider what you would do in that scenario. But also, I think it's foolish to act as if it is true when it is not currently true. You know, there are plenty of people who are sitting out of the market because they're unsure what's going to happen with the CGT proposed CGT changes. And that is costing them a huge amount of
out
potential.
of the market, like not acting, not buying anything because
correct. Yeah, correct. Because it's super interesting. But actually, this happens more often than not. You know, like I saw someone the other day. It might even be digital nomady here in the chat. Actually, might have shared that somebody, because of and we'll potentially get on the geopolitical stuff a little bit later, but because of the geopolitical situation in Iran, they wanted to pause on investing. It's like, okay, that's interesting. Like, why? Like, why would you do that? So let's not segue to there, because we can cover that. We can cover that later, because I think it's really interesting as well, and it's actually presents a bullish case for Australian property. Just as there's the liner note, by the way. So, but people hear these things and it creates uncertainty. Uncertainty causes them to freeze, fight, or flee. Most people, out of those, by the way, 66% of those three options include not taking action: freeze, fight, or flee. One of them is flee. All right, I'm not going to get involved. Another one is freeze, which is analysis, which is paralyzed, do nothing. And so the significant bias, a 66% bias of activity, is towards doing nothing or getting away when the circumstances dictate a degree of uncertainty. And so people are hearing about CGT changes. They don't understand it. They're worried about what it might mean. And rather than actually taking the time to really consider through this, what this could mean and how much actually risk is there, they choose to do nothing. And I think that's a really big mistake, because you know what we are seeing right now, and we've been talking about this for some time, is a significant boom in the real estate market. There is more demand, depending on what markets you're in. There is more demand than we've ever seen in the markets that we're in. Like literally more demand in all of the markets we're buying in. We've never seen this level of frenzy to get properties. And if you think that sitting out of the market is going to be somehow advantageous to you, I think you're sorely mistaken. Now let's get onto the CGT stuff in a bit more detail. So there's a proposal there's a variety of proposed changes, right? And this is the thing, there is no fixed set, this is what we're going to do. They're proposing changes which could mean a reduction in the CGT discount. So for those of you who don't know, if you own an asset for longer than 12 months, you are eligible to get a 50% CGT discount. So what that means is, let's say you buy an asset and it goes up by $100,000 and you own it for 13 months, right? Your taxable gain on that is $100,000. So what they'll do is they'll say, actually, we'll apply a 50% CGT discount, which means we'll only tax you on 50% of the $100,000. So they're only going to tax you on $50,000, and then that's taxed at your marginal tax rate. Now, if you were only earning, let's say you didn't have an income, right? Then that $50,000 would be at the lowest marginal tax rate. But for most people, it is going to be in addition to their income. And if you're selling a property or something like that, typically the amount is going to be high enough that it might push you into a higher tax bracket. And so the easiest way to kind of think about this, particularly if you're talking about multiple hundreds of thousands of dollars of gain, which, by the way, if you're making multiple hundreds of thousands of dollars, you're doing something right. So that's something to be celebrated. Is most likely you hit the highest marginal tax rate, which is about 48%, but you get a 50% discount on that. So if you take $100,000 times 48%, that is, I think it's 48%. Don't quote me on that. I'm not an accountant. That's $48,000. But then divide that by 2, and you get to 20. Works out to be 22.5%. So I've got something wrong in the maths there somewhere along the line. It works out to be about 22.5% tax, which I will point out is actually lower than most people's income tax. Most people's income tax is going to be in the 30% plus tax bracket. So people have this like fear of CGT, whereas in fact, if with the current 50% CGT discount rules, when they are applied, typically the amount you pay on CGT is less than what you would pay in income tax. So to me, I would rather make a capital gain than increase my income. So that's how I would think about that. And a lot of people don't think about that. They just think about like, where's the income? Where's the income? Where's the income? I need more cash flow. I need more cash flow. I need more cash flow. It's like, I would choose to make $300,000 a year in growth over $100,000 a year in income. But that's me personally. Now,
even if you just side note on that, it's like, even if you think about like the method at which you are making that gain compared to your income, like your income is you trading your time for money. Obviously, over time, we hope that our income goes up. We are working for that. but gain in an asset that you bought strategically and bought well.
Yeah, totally. But even if you're talking about cash flow from assets, right? This is actually the point that I'm making. Like even if you've got like dividends, or if you've got rental income, or you've got like me personally, like my point of view on this has like necessarily our ideas should evolve over time. That's how we grow as human beings. So, I've gone from, how do you create a massive income stream through which income replacement, and having an income stream is very important. I mean, it's one of the benefits of real estate is that it is both a commodity and a utility. It gives you both growth and income. And so you can actually have the best of both worlds with real estate, which is awesome. If you're buying Tesla stock, for example, Tesla has never paid a dividend and will never pay a dividend. Well, you can never say never, but that's they sort of have openly stated they've never paid dividends. So you might get a bunch of growth, but you would never get an income stream. And for some people, they want an income stream, and having both is good, right? So there's a bunch of reasons why real estate is a fantastic asset. But just even on that, it's not even just on your like trading your time for money. If you've got a portfolio, let's say you've got a property portfolio that produces $100,000 a year of income, as long as you don't own bad assets, it's almost certainly going to be creating you a lot more than $100,000 a year in growth, right? Just because of the size of the portfolio. So you're going to be making more money, not from the income side anyway. Now, the proposed changes are a reduction in the 50% discount rate, potentially to 33%, potentially to 0%. But again, it's all a proposal. Like no one knows at this stage. Yeah. And here's the kicker, right? So let me cover off a couple of points, because I think you might have some good questions about this. People are acting as if this is just property centric, but to the best of my knowledge, and someone might correct if I'm wrong, correct me, but to the best of my current understanding, this is a CGT. This is a proposed change that would apply to all CGT, which also includes shares, crypto, business sale. It's not property specific. And so if it's going to affect all asset classes equally, then should it even change your investment thesis? Like if there's a reason that you're investing in property versus shares versus crypto versus business, or maybe you have a diversified portfolio or whatever, but you still have a reason to want to invest in real estate. If the tax changes affect all asset classes equally, why would it stop you investing in real estate? Because the underlying thesis of why you would want to invest in that asset class won't have changed fundamentally, right? Because
it would be more a question of investing at all, rather than
exactly. If paying slightly more tax is a reason to not invest at all, what else are you going to do? Like, how else are you going to get ahead? Because your income is not growing faster than monetary debasement. Your income is not growing faster. So you're only going to get further behind. So you still have to do something to get ahead. Now, not to be too explosive here. I mean, you could choose to leave Australia. Like if you're not satisfied with it, I actually have a friend at the moment who is currently not satisfied with that, and as a result is making a choice to leave and to cease being a tax resident. Like literally, he's exiting the Australia. He says, "I don't want to participate in this tax regime," and that's a reasonable position to take, but that is not the position that most people take, right? Like that is an edge case scenario to say, I don't want to participate in the tax system here anymore. And so unless you're willing to do that, unless you're willing to like move to Dubai or something like that, which is obviously, a huge decision and outside the scope of what most people would be ready, willing, or able to do, then what you're actually talking about is you're talking about a blanket change to capital gains taxation across all asset classes. Now, if they decided to make it a property-specific tax change, I think there would be such a tremendous uproar. I just don't think it's possible that would even survive the populist vote, because property is so central to our entire wealth system. You want to add something?
Well, while you were speaking, I just ran the numbers on just the very two ends of the situation. So we have the current scenario being like 50% discount. And let's just assume, because maths live on a podcast, I just assumed 50% income tax rate, right?
Sure. Yeah.
It's rounding up a little bit, so whatever. But if you made $100,000 gain, you get a 50% discount on that. So it's $50,000 is what you are taxed on.
Yep.
At a 50% personal tax rate, that means you would pay $25,000 CGT. So from a $100,000 gain, this is also considering, right, something has grown and you are deciding to sell it. So it's grown $100,000. you still net $75,000. So that's the current situation. Your own
Correct.
tax situation pending, blah, blah, blah.
Yeah. This is not personal taxation advice. Yeah.
This is me jotting on a notepad. I think the max proposal is for a 25% discount, right? So if we take those as the two ends of the spectrum, if we run it at a 25% discount, we have a $100,000 gain. We reduce that to $75,000, and then you're taxed on $75,000. If you keep the same tax rate, 50% for easy maths, you pay $37,500 in CGT. So it is $12,500 more. But at the end of the day, you are still walking away from making $100,000 total gain, top line. You still walk away with $62,500. So that's obviously there is a difference between that, right? $12,500.
Yeah, and of course,
not
pay more taxes.
Totally. But end of the day, you made an investment and you still get to walk away with $62,500 gain. And that's these are the two ends of the spectrum. That's like the most dramatic of the options.
Yeah, and back of the napkin maths, that would probably put you roughly in the ballpark of what your income tax is anyway. So like you've made, put you roughly in that ballpark of what your income tax situation would be anyway. So you've made $100,000 and you've been taxed on it like it's income, pretty much. What's the big deal? Now, again, I don't think CGT should exist. I hate taxation. There are completely different ways to economically run our country that don't involve all of these bullshit taxes, to be honest. That being said, the taxes are what they are, and let's not overplay the severity of them. You're making money, you're paying taxes on that money that you receive. The other thing as well is that people are worried that it's going to impact their pay. So it's like, oh, it's going to push me into a higher tax bracket, and therefore I'm going to on a week to week, day to day, week to week, month to month basis, I'll be taxed at a higher tax rate on my PAYG income, which again, to the best of my current understanding, that is not true. So because it's an event-based taxation, and so you'll pay the higher marginal tax rate you'll end up with a big tax bill, but your employer pays you a PAYG tax withholdings. And so they're not going to, they don't necessarily know about your individual asset sales, and you're not obliged to tell them either. So they're not going to adjust your PAYG withholding at the income level. So it shouldn't affect your day-to-day taxation. Now, at the end of the year, when you're reconciling your taxes, you have a big tax bill. But I know, because I've seen one of the threads around this is like, does that mean, let's say I sell a property in July, does that mean that for the rest of the year, my income is going to be taxed at the highest marginal tax rate? And does that mean that on a week-to-week basis, I'm going to have less money? To the best of my knowledge, this is not tax advice, yada, yada, yada. That doesn't appear to be true. And so it's an event-based, it's a realization event tax, and you'll end up with a tax bill at the end. But we know that already. So I think people need to stop over-exaggerating the impact of this. It is, as it's currently proposed, going to apply to all assets. So if you believe that real estate is a good asset, it's not going to change, because all of the assets are going to be taxed in the same way: shares, crypto, business, property. It's all going to be taxed in the same way. You're getting taxed on making money, even with the 25%, 25% versus 50%. It's still going to be roughly equivalent to what you would pay on an income tax basis. So you will receive, if you earn $150,000 a year, and then you make an additional $100,000 gain from selling an asset, it's going to be treated like you made $250,000 in a year, roughly, is the way to think about it. And it's like, okay, so you pay tax on that. If you earn $250,000 in a year, you'd be paying tax on that anyway, right? So I think people need to just chill out on this. Now, here is my big contrarian take. This is actually bullish for property. This is the big contrarian take. So if you think about what this might mean, what are the downstream effects of this? Well, people might not want to pay more tax, because I know I don't want to pay more tax. So people might hold on to assets for longer, which is interesting. And if people hold on to assets for longer, what does that mean? That means lower transaction volumes across the board. What does lower transaction volumes mean? Less stock availability. That doesn't mean that there's less demand, particularly with migration increasing and stuff. It just means that people hold assets for longer and don't sell them. And so if there is less stock turnover, if there are more people holding onto assets for longer, then that could translate into tighter stock availability, which could actually push property prices up. So you could actually you're going to actually potentially get more gain over a shorter period of time because less people are going to transact, which then you have like a bit of a rubberiness to this. It's kind of like people will hold assets for longer, which means less stock on market, which means prices theoretically would rise faster, which means that you'll make the gains faster, which means you wouldn't need to hold the assets for longer because you'll achieve more of the gains sooner, which means you could sell a little sooner. And so there'll be some kind of like midpoint equilibrium on this. But I think actually the big contrarian take on this is them days think that if they lower the CGT discount, somehow that's going to create more housing affordability or something, or maybe it's just revenue raising. Maybe the only reason they're trying to do it is revenue raising, and maybe that's it. But regardless, I think the net impact is actually bullish for property, not worse. Because I've heard people say, "Oh, that means that property investors, lots of property investors are going to exit the market." It's like, why would they? Where are they going to go? Their capital has to go somewhere. Are they going to go suddenly? Is someone who has already decided that property is their main investment vehicle and has a $10 million property portfolio, are they going to suddenly sell all of their assets and then go and put it in shares? I don't think they will, because they're going to get taxed in the same way, but they'll have all of the things that they didn't want out of shares: more volatility, more liquidity, more drawdowns, more risk. The other thing as well on this, there's talk about before I move on, that behavioral consequence of being bullish for the property market. I just really want people to think about that, because everyone's like, oh my God, this is going to mean that property investors are going to leave and therefore properties are going to flood the market. Therefore property prices are going to go down. No, that's not going to happen. And by the way, just as a little thought exercise, I want to get onto grandfathering in a moment. As a little thought exercise, let's say there was some situation that caused every property investor in Australia to sell all of their properties all at once, all on the same day. Roughly 33% of all properties in Australia are investment properties, are owned by investors, roughly 33 to 35% or something. Let's call it 33%. Let's say there was some situation that caused all property investors, let's say property investing became illegal and every property investor had to sell their property on the open market. What would happen? Well, in principle, you would imagine that the house prices would go down by 33%, right? 33% of supply would enter the market, property prices would go down by 33%. Number one, that would only take, so the median property price in Australia is about $1 million, right? So that would let's say 33% of $1 million, about $1 million, that would reduce the median property price to about $660,000. That's still not that affordable for most people. Most people are still struggling to get into the property market at $660,000. But also what would happen is prices would go down and it would meet the demand. There's so much demand for property of people trying to buy. So as prices came down and more people could afford to buy that, they would bid up the bottom. There's a housing shortage in Australia. So they'd bid the bottom back up again. And so I don't even know net if you would even have any meaningful, you may have some price volatility for a moment in time, but I don't actually know if net you would have any price decline. All you would have is more homelessness, because there would be less places for renters to be able to live, because there'd be more first home buyers that push into the market. And we've actually seen that play out. That's actually happened in plenty of countries around the world, where homelessness increases when they disincentivize property investors from owning properties. Because there's this kind of like false belief that property investors are somehow doing a social injustice by stopping homeowners getting into the market. But there's always going to be renters. I remember when I was renting in my 20s, I wasn't renting because those damn property investors owned all the houses and I couldn't get one. I was renting because I had no freaking money. I didn't have a deposit. I didn't have the types of jobs that would even allow me to get a mortgage. It was so like I wasn't a buyer. I needed a place to live. And if there was less properties available on the market, rent would have been more expensive. That would have squeezed my affordability. That would have made it even harder for me to get into the market. Like these things all have second order consequences. And I just want to make one more point. So there's talk about potentially grandfathering this, like if you buy a property before, or if you own a property before a certain date, then if these CGT changes were to go through, if you owned a property before a certain date, then they wouldn't apply to you. It would only apply to new purchases or something to that effect. If that happens, what do you think is going to happen? You're going to have everyone rushing to get into property, and it's going to create a massive price spike. And it's not going to go down. Like, that's not what happens. The prices will go up. They'll find a new floor, and then guess what? The average entry price to get into property is just suddenly going to be higher. So if you're sitting on your hands going, I better wait and see what happens with this CGT stuff first, probabilistically, you're just going to miss out. Or you're going to miss out on significant gains, a significant opportunity. I don't really see a positive upside to sitting out. It doesn't actually make any logical sense other than just making you feel good because you had more information. It doesn't make logical sense to me.
Yeah. I think if you think about, we've talked about on the show, particularly considering like different asset classes, it's like, has the thesis changed? Like, has the thesis for property changed? It's like, this is a rule in the game of Monopoly that is maybe potentially shifting slightly, but does the underlying thesis of property being a great asset class and the right time for me to be considering in the realm of my options to invest in as an investor probably hasn't changed. Like, this slight little rule means you like can't collect $200 on the next time around the board, but it doesn't change the underlying thesis of this is still one of the strongest asset classes you can invest in.
100%. So, and we actually have a few questions here that are kind of all woven in. I know we were going to go on to like a follow-up from the K-shape next.
No, I was going to skip that one. Or like,
okay, where do you want to go next? Because there is some other stuff that is all tied into this general theme, actually, because it's really. Where do you want to go next?
I think relating to, like, we kind of touched on affordability, relating to like property strategy. I think I want to just chat about your perspectives on if like asset types or asset classes within real estate, if that's changing for people, because obviously like affordability is getting worse. And so the median prices of everything are going up. And so do you see that meaning that people, it makes more sense to invest in units versus like holding out to try and save extra deposit to be able to afford a standalone house? Like, where does that payoff come in?
Yeah. So we've often talked about a framework for suburb selection, a very simplified framework being jobs, lifestyle, and relative local affordability. I would update that now to be jobs, lifestyle, affordability, and capital flows. Now, what's interesting is I've taken the relative out of the local affordability, relative local out of the affordability aspect, because it's also been propped up by capital flows. Now it's interesting. This is an evolving thought, by the way. This is not like a finalized. I saw your face change there.
I'm just thinking through, if people haven't listened to the show before, can you just quickly define capital flows in this context?
Yeah, so capital flows is the movement of money through an economy, and what we've identified is an increase in the financialization of real estate. So what's happened is, there's this sort of, social contract has been broken. So once upon a time, we were led to believe that if you worked hard, got a good education, worked hard, got a good job, that you would, through the fruits of your labor, be able to afford a good lifestyle for you and your family, buy, the great Australian dream, buy a family home, raise a good family, give them good education, good food, and, live a good life. That social contract has broken, right? And this is, it's kind of like the broken promise that people are just starting to wake up to. And they're waking up to it either implicitly or explicitly. A lot of people aren't actually consciously aware. What they are just feeling is this sense of things feeling harder. Like, why does it feel so hard all the time? Why does it feel like this? Most people aren't aware of the why. They're just aware of the feeling that they've got, that it feels so much harder. And so once upon a time, investing was optional. Investing was something that you could do if you had some spare cash and you wanted to be a bit savvy and try and make a bit more money, but you didn't actually need to do it, because through the fruits of your labor, you could afford a good life. That is shifting. And more people are either implicitly or explicitly aware that they need to invest if they want any chance of being able to live the kind of life that they dreamed of. And when I say dreamed of, I don't mean super yachts. I mean raise a family in a good home and go on holidays and take the kids out for activities and stuff like that. I mean like a good quality, a good standard of living, right? And most people there are lots of people that are questioning whether they can have families because they can't afford it, right? And so investing has become something that is a necessity, not an optionality, not just an option. And so with that, people are then asking themselves, either again, implicitly or explicitly, because a lot of people are having these sort of subconscious conversations or this feeling that they need to do something. It's not necessarily like, oh, the promise is broken, I better go do something. It's this sort of like sequence of feelings that are leading them down a path where they're choosing, or they're realizing their money needs to work harder for them because they can't work harder for their money. You know, their wages are not keeping up with prices. And so just putting in more effort to create at their job is not necessarily going to get them ahead. So then people are faced with a choice. So what is the choice? Okay, well, if I've got to do something with my money, what am I going to do with my money? Do I invest in businesses? Do I invest in business, shares, crypto, or real estate? Broadly, that's there's very few people sitting out there. I'm going to get and deciding to become like a gas futures trader or something like that, natural gas futures trader. So it's pretty much business, shares, crypto, or property. And most Australians have a really strong affinity with property, and I think that's for good reason too. And again, a lot of this stuff is not explicitly understood; it's implicitly understood. Australian residential real estate represents the best risk-adjusted investment opportunity that I can see on the planet anywhere. I have said that time and time again, and I will continue saying that. And I would challenge anyone to prove otherwise. It is insane when you actually break it down. Now, the couple of caveats: well-selected real estate, in line with the well-developed personal strategy using leverage, right? There's a couple of additional kind of caveats in there as well. But assuming that you do it well in line with your personal circumstances and you use leverage intelligently, then it's the best risk-adjusted return on the planet. And so people have a strong affinity with property in Australia, and so they are sort of going, okay, well, how do I get into the property market? Whether it's just a feeling that if they can just get into the property market, that's going to eventually help them to buy a home, because that's what most people want. They just want the ability to be able to buy a home and raise a family. It's really what they want. And most people don't like the volatility or the feeling of speculation that is involved in things like crypto and shares and stuff like that. And we can talk more about those asset classes either later or maybe on the next episode. There's a lot of stuff going on there as well. And so this then goes to the capital flows, because people are saying, okay, well, where am I going to put my money? And the financialization of real estate is the fact that more people are waking up to the investment side of real estate, not just the home ownership side of real estate. And through technology and the general nature of progress in society, our ability to invest at a national level has not just for Dashdot, but just as investors, the technological capabilities that have enabled us to invest at a national level have enabled capital flows to move more readily around the country. Now, just a quick note on that, by the way, we actually did, and shout out to Dr. Chen C, our head of data science and AI. What we actually, I'm just quickly grabbing some data here. What we have actually so Julian and I did an episode, two episodes ago, where we specifically spoke around this. We've covered the financialization of real estate, so go check out some of the previous episodes. But Dr. Chen C produced a report that we got last night that and this is around cycle durations, that the cycle durations are actually shortening. So we looked at the property market since 1993. I'm just quickly trying to decipher some of this data really quickly. Look at the property market since 1993. The punchline is that pre-2010, the median property cycle was 7.7 years, and post-2020, it's down to 4.1 years, which is crazy.
Wow.
Yeah, which is insane. So that's what a 40%
I want to
reduction.
dig through that. That's really interesting.
Yeah, it's super interesting. And look, that's a whole episode in and of itself. So
yeah.
But what that actually points to is the acceleration of the financialization and capital flows through the market. So once upon a time, and so property markets are still fundamentally driven by home ownership. And so for any location to have long-term, stable, high-quality investability, it must have good economic opportunities for the people who live there. But with remote work, those economic opportunities don't necessarily have to be geographically located, although most of them will be, right? But let's say 10 to 20% of the jobs in an area might be remote, which means that 10 to 20% of the economic capability doesn't have to come locally. So, but there needs to be enough economic opportunity for an area to be economically viable, sustainable, stable, provide an opportunity for prosperity for the people that live there. It has to have a good livability status. Like, people have to want to live there. It has to be something nice. And look, nice is subjective. Lifestyle is subjective. Some people prefer small country towns. Some people like to live by the beach. Some people like to live in the mountains. Some people like to live near deserts. That is subjective. But for the people who live there, there has to be a desirability to live there. That's the livability aspect of it, right? So that's the lifestyle aspect of it. Now, affordability is a really important one because relative local affordability would be how we would traditionally look at it. And we still do look at it that way, by the way, internally. And that is how affordable is the real estate market based on local incomes and capabilities, because most of the people who buy real estate are going to be homeowners locally. However, because of the financialization of real estate and because of the increase of capital flows through the market seeking opportunities, that has enabled a different lens on affordability. That lens on affordability is what markets have enough investable characteristics, so jobs, lifestyle, and demand and all of this kind of stuff, and are at an affordable enough entry point that people can get a foot on the ladder. So what that means is, let's say that based on local incomes, the relative local affordability point for an area is $400,000, right? Someone who lives in Sydney who earns $250,000 a year, they might look at that and they're like, well, that's cheap, but I can't afford to buy where I live. So I'm going to go and move my capital to that market because that looks like it has enough investable characteristics that my capital is going to work for me and I feel safe and comfortable with that. And that affordability is still relative to them where they are. So there's a geographic aspect of the affordability chase, which is driving the capital flows. So money is moving and chasing opportunities. Now, I did a podcast with Mike Mortlock on the Gear for Growth podcast, which I highly recommend people check out. It was really interesting. And we spoke about Darwin. And just to be clear for anyone who's listening, Dashlot has never bought in Darwin. We did not participate in that whole kind of thing. And I don't think that's going to work out well for a lot of people there. The whole reason that people piled into Darwin is because they looked at it and they said the houses are cheap and the rents are high, the yields are high. They completely ignored the fundamental basis of whether it was a good place to invest or not. They just said, look, it's cheap and the yields are high. Let's go there, right? Mm-hmm. And if you're a property collector, sure, maybe that's an interesting idea, but that's not how we want to build portfolios. And so this is the capital flows and affordability aspect that people are chasing. So what does that mean? So what that means is the more expensive markets, places like Sydney, where people are increasingly, because wages are not keeping up with property price growth. So property prices are going to grow to the limits of what people can afford. So what you'll find is there is an upper ceiling threshold where demand starts to diminish because fewer and fewer people can afford to buy properties at a higher price point. So is that $1.5 million, $2 million? Like there are less people who can buy $2 million properties than people who can buy $1.5 million properties. And there are less people who can buy $1.5 million properties than people who can buy $1 million properties. And there are less people who can buy $1 million properties than there are people who can buy $500,000 properties. So as you go up in a price point, the total number of potential buyers goes down because of their ability to afford to buy those properties. And that's a combination of income, savings, and access and credit, right? So credit, that's the three constraints, right? Credit, capital, and cash flow. And so those three constraints actually put a soft ceiling on property prices. I say a soft ceiling because that will incrementally still increase, but that's going to increase slower than the entry point into property is increasing. So because more people can afford to buy the cheapest parts of the market, there is more demand on the bottom end. So if you imagine that there's two lines, there's like the baseline entry point, and there's kind of like the maximum price point that people can afford. And that what is happening is the bottom line is going up faster than the top line is going up. So the floor is being raised on property prices because people are chasing affordability. So what is that? What is the second order effect of that? So what that actually means is that, subject to, again, markets having solid investable characteristics, you do not want to just chase cheap. Cheap does not equal good, right? Like a cheap suburb doesn't make it a good suburb. A cheap house doesn't make it a good house. Cheap does not equal good. What you want is good quality assets in good quality markets. That's what you want. Now, what is happening though is people are chasing good quality assets in the most affordable, good quality markets. And so the best, cheapest, right? The interesting combination of like the best, cheapest markets that have got good properties and good communities and good opportunities and good livability and stuff. That's where all the demand is flowing. Now, here I'm getting to an even more interesting point. we're certainly at least as interesting a point. So that I think people can understand that. So they're like, okay, cool. People, rather than if the median house price is $1 million, suburbs where the median house price is $400,000 necessarily is going to have a lot of demand. I think people can understand that pretty easily. What's also interesting though is that property types are changing. So, or the demand for property types are changing now. And so what I mean by that is like houses versus units, which is I think where you started this question.
Yeah.
So the age-old belief, which I also believed to be true for a very long period of time, is that land appreciates, buildings depreciate. Now that is a fact, not a theory. Right? That is a fact, not a theory. Land does appreciate, and buildings do depreciate. Buildings wear out. Buildings break down. Buildings left alone will eventually collapse into rubble. They depreciate. The land is going to still be the land. So it's a fact that buildings do depreciate. However, it is not necessarily enough. That fact is not necessarily enough to carry the weight of demand and capital flows to dictate your investment strategy. So once upon a time, I would have said, and we actually openly said, don't buy apartments. For years, we were like, why would you buy an apartment, right? Yep. Because you don't own the land. Buildings, land appreciates, building depreciates. Buy a freestanding house on land. That was our working thesis too, until we had new information that kind of proved that to be incorrect. So back in 2024 is when we really started, maybe it was 2023, is when we started meaningfully, I think it was 2023 when we started doing meaningful studies on the potential for unit markets, because households are getting smaller. So the average number of people per household has dropped from, I think, 2.6 or 2.7 down to about 2.2. Don't quote me on that. And you might think that that's an innocuous change, but that's a very significant change. There are more people living alone, or less people living in households, yet at the same time we have a higher population. So if you have a higher population and a less density per household, that creates more demand for properties, but also more demand for smaller properties as well. Now, one of the big issues with units is also been supply risk, because you can, the whole idea is you can continue, the sky's the limit. You can continue to build upwards. And we've seen plenty of examples of markets where there was oversupply of units. So think of Port Melbourne, or Docklands and stuff in Melbourne. I can't remember the suburbs in Brisbane, but there was this massive oversupply of units in Brisbane, massive oversupply of units in parts of the Gold Coast. And what that did is that caused really, it caused an economic cul-de-sac to form around these pockets where prices didn't go up because it was too much supply, not enough demand for those asset types. And so there is a risk element that you need to understand when you're thinking about units and apartments. And so you need to be very clear on, what the potential of a supply coming into a market is and all that. It's not, you have to be cautious. That being said, there is more demand for units as well. Now, a very interesting piece of information that came through, and shout out to Andy Bernados, the Spanish stallion, who did a little bit of analysis. He's been on this podcast before, crowd favorite. So he looked at since April 2024. So Dashdot started buying units in April 2024. Now, when I say Dashdot started buying units, we did not take a wholesale approach that just said, okay, units are on, just buy units. It was very, and still is, very meticulously guardrailed to make sure we're only buying the types of units that are able to capture demand without being exposed to oversupply risk. So we have a very methodical approach. It doesn't just mean binary units on, go buy units and apartments, right? It's not that simple, right? So we have a very meticulous and methodical approach to making sure that we're only buying supply constrained, high quality assets, the right type of assets. But we started buying units in April 2024, and this stat absolutely blew me away. Out of the top 40 properties that we bought since April 2024, which is a lot of properties, by the way, that we've bought since April 2024. Since April 2024, of the top 40 properties we bought, 35 were units and only 5 were houses. That is insane. So let's call it 2 years, in the last 2 years, 35 of our top 40, nearly 2 years, 35 of our top 40 properties that we bought for our clients were units.
Mm.
Now, again, I will re-emphasize the point here that this is not a wholesale advocation that everyone should just go buy units. It's not that simple. You need to be cautious. Just in the same way that you can't just wholesale say go buy houses and then you go buy some, off the plan house and land package in the middle of Upper Kabukta West with no opportunities, and you're going to lose a whole bunch of money. None of this should be taken as like binary information. But what is interesting is what information is contained in that fact. The information that's contained in that fact is that the old premise of houses outperform units is not necessarily true. And if you understand how to select the right assets in the right market in line with the right individualized, personalized strategy, because a portfolio is not a collection of houses. A portfolio is a sequence of investments that moves you from where you are now to where you want to be. So the right assets selected in the right markets in the right way for your portfolio strategy mean that you can achieve exponential returns and exceptional returns, regardless of whether it's a unit or a house. It's about picking the right property in the right place at the right time for the right strategy. And that I think is really, really interesting. And I know I'm sort of running off at the gob here a little bit, but this started with a question about affordability, right? And so what we're actually seeing is a complete change in market dynamics, particularly over the last 6 years, right, since COVID, right? And so those market dynamics are changing. Household sizes are changing. Demand for different property types is changing. How capital is moving through markets are changing. And so people are seeking affordability. People are seeking to get on the ladder. People are seeking all of these kind of things, but they still have to have these kind of like fundamental elements around it. So that is
fascinating.
And Finn.
Yeah.
It is fascinating. What do you
It's
think
another study I want to look into. I haven't seen that one from Andy. That's pretty cool.
Yeah.
All of this, I just find it all very interesting because it's like there's the classic Darwin quote of like, it's not the survival of the fittest. That's not the quote.
It's not. Yeah,
it's
not the strongest or the fittest or the fastest or whatever. It's the most adaptable, right? It's
the most adaptable to change. Yeah. People truncate it to be like survival of the fittest, but it's actually the most adaptable. Yeah. And with all of this, it's like we have, like, I'm sure a lot of people listening to this are still struggling with the idea that like an apartment can outperform a house. And I think,
and 35 of our top 40 performers, 35 of our top 40 assets that we bought over the last 2 years were units. That is not occasionally a unit can outperform a house. That's a complete change in the sorry, go on.
It's all right. It's just like in the context of, you've talked about it on this show before around like the fundamentals of the market are completely changing. And this is our, I'm sure people listening to you, we've got a really amazing team who are always like forecasting and looking forward to what is changing so that we can adapt before anyone else. And this is the kind of thing like us in 2024 being able to put our hand up and say like, I think it's time. I know that we've been saying apartments, like don't go near apartments for years, but at that point we went, you know what, this is shifting. We're placing an educated bet at this point, and then being able to see that through. I think it's just like I think through how our business specifically has been able to consistently get such insane returns for our clients. And I think so much of this it's because our ability to forecast and look forward and see everything from this massive macro view looking down and being able to forecast and predict what's going to happen to the best that we can, rather than just being stuck in these rules of we only buy houses on at least 600 square meter block. We only do X, we only do Y, and being just like sitting in that for the whole life of the business, and actually that being a net negative impact on the results that we can get for clients. It's just all very interesting. It's just like that, our ability to
100% agree with you. I 100% agree with you. And it's like, it's a willingness to challenge all of these assumptions that is actually, I think, been a significant contributor. I mean, we've built crazy technology. We've done all kinds of different stuff. We have an amazing team. There's so many factors in why we've been able to get. I mean, what is what's the latest stat? The the average, the median 3-year return on invested capital, or the median 24-month return on invested capital for our clients is what,
168%.
168%, and that's across what, 2,700 properties now.
Yeah,
Like that doesn't happen by accident. That's not a couple of good purchases. That's a system that works consistently, and but that system isn't static. And this is kind of the point is that you're making, is that in order to continue to find that alpha in the market, you have to continue to be adaptable, even more so in the current environment, because there's so much change happening so quickly. Just before we move on, like one of the other kind of like inbuilt assumptions in what we've been talking about as well is that if land appreciates and buildings depreciate, then surely you just want more land, right? Surely you would just want more land. Well, okay. I remember when I was a kid, I saw because I grew up in a country family, and my dad was in part of the Sporting Tutors Association. And I was looking through like a gun magazine, and there was this land for sale in the middle of nowhere, for $1 an acre, right? And I was like, Dad, can we go buy some? And it was, anyway. But we did a study. We did a study on the relative importance of land size to value or to growth in urban areas or in suburban areas. We did that back in 2020, must have been 2020-ish, when we were buying in Devonport for the first time. And so because we were looking at a couple of properties, and they were in like very similar parts of Devonport, and one was like 520 square meters and one was like 660 square meters. And it was like, okay, objectively speaking, should the 660 square meter property, land size property, grow faster than the 520 square meter property? Well, actually, no, right? Because it doesn't meaningfully change the demand profile of those assets in those areas. Now, it only matters when you get to a point where the land size is subdividable. So if the minimum lot size, for example, was say 500 square meters, then the only time that it would change is if the block size was 1,000 square meters or more. And then actually, it's not actually that it would grow faster. It's that it would have more inbuilt economic opportunity because you'd be able to subdivide it, subject to it being subdividable. So again, the land size, just as a binary, was not the actual deciding factor, because if that land was crisscrossed with pipes and all of that, sewers and stuff like that, if you weren't able to subdivide it, if it was on a steep slope, if you weren't able to subdivide it, then 1,000 square meters didn't matter a pot. It wouldn't make a difference whether it was 1,000 square meters or 550 square meters. It wouldn't matter. So the subdividability might create some increase in value, but also the sale price would have that value baked in. And so you're not going to see, say, in inverted commas, more growth by a larger land size. You would pay more money for the optionality to be able to subdivide that down the line. And so, there's obviously limitations to this, because like if you're in a suburb where the average block size is 500 square meters, and then there's a property that has a 200 square meter block size, there's probably going to be net less demand for the 200 square meter block size than if every other property in that suburb is 500 square meters. There'll probably be net less demand, because we're like, do I want that like tiny thing? But it's only when there's like some huge disparity. But basically the point here is that like you can't measure growth by counting the square meters of a piece of land necessarily. Like it's driven by so many other factors. So the whole like land appreciates, buildings depreciate. One side of that is true, which is that buildings do depreciate, but land appreciates only in the context that there's sufficient demand based on a whole bunch of other factors. It is not actually the land that itself that causes the growth. It is the demand for that land at any given point in time based on a variety of different market dynamic characteristics. And you touched on a really good point as well a moment ago, that market dynamics are changing. It is so fascinating. The thing that keeps me interested in this game is that it keeps changing, because if the property market didn't change, I would be bored as shit. But the fact that literally all the time we're uncovering new and interesting facts and features around market dynamics, market structures, like how it's gone from like a supply demand commodity based matching market type. It's fascinating. It's truly fascinating. So back to the point, has affordability changed how market dynamics are moving? Yes, it's changed property types and locations to buy in, right? So units are on the table, but again, that is not a wholesale advocation to just go buy units. Well-selected units in the right places at the right time based on an individual personalized portfolio strategy make a ton of sense. Land in and of itself is not a defining characteristic of growth. More capital is flowing into trying to find those that financialization opportunity because more people need to try and get ahead. So do you think we've covered off that point? Any other questions or points you want to make?
Yeah, there's another topic I want to get your perspective on relating to like asset types and property types and whatnot, because we've always advocated for established properties in established areas, right?
Yeah.
And I'm just thinking through affordability. A lot of people are struggling to get that first deposit. A lot of people do you think that there would be a case at any point for someone who can afford a house and land package or like at some kind of new build opportunity that they can afford so that they get into the market and they become an asset owner versus not?
I think that is less about whether it is a new build or a house land package or whether or not it's the right opportunity for the capital, right? Because we're not out there to try and collect assets, right? The goal isn't buy a house.
No. Yep.
Right. The goal isn't just to collect assets. So if someone presented you with an opportunity for a house and land package that was 600 kilometers west of Alice Springs, but it was affordable enough for you to be able to buy it, and it was a house and land package, would it be a good idea for you to buy that house and land package because, in inverted commas, you'll get on the ladder, you become an asset owner? I would argue no. I would say that is not a good idea. That is like saying, hey, I want to invest in shares. So what I'm going to do to consider myself a share owner is I'm just going to go find the cheapest shares that I can find. I'm going to find some penny stocks and I'm going to buy some, and then I can call myself an investor because I own some shares. Oh, okay, great. It doesn't mean anything.
Yep.
So a different way to think about that question is it ever appropriate to buy or build a new property? Yeah, absolutely. Of course. Are there some circumstances where some house and land packages represent significant, represent a significant economic opportunity? Yeah, there are some, right? So just in the same way that just because an established property is an established property doesn't make it somehow some magical growth vehicle. You know, I've mentioned several times before, but you know, I met a family. They were third generation real estate family. They owned a real estate agency in a part of Sydney. I won't mention the part of Sydney, but the third generation owning a real estate agency in this part of Sydney. So they knew the market. 3 generations, right? The grandparents started it. Then the parents took it over, and I was talking to the kids, and the kids were like fully adults, had family and stuff, like full real estate family, knew the area better than anyone else. They bought property in that area, an established property in that area. 10 years later, it was worth exactly the amount of money they paid for it, right? They bought an established property. So saying that all house and land packages, or saying that no house and land packages cannot make money, is just like saying that all established properties will make money. Both of those are false statements. And so the question is actually, how would you define whether or not something represents an acceptable investment opportunity? Now, there are some cases where, so as a general guiding idea, like unless you're getting in the first stage of a development, you're probably going to miss out on a lot of the gains. So in a kind of like a larger house and land development, if you can get in the first stage and if you can pay the right price at the first stage, then you can generally have a higher probability of getting uplift. But I have also seen personally, because people have come to me seeking help personally, where they have gotten in on the first stages of a development that was a development in the wrong area, and they had lost money. So like, you can take this sort of point of view that like, okay, the best time to get into a house and land, like, kind of like a greenfield development is to get into the first release. And that can be true if that development is in the right place at the right time. But just in the same way, it can also be not true. You can buy the first property that gets released, the first package that gets released on a development, but if it's in the wrong place, it's not necessarily going to make you money. Now, let me go back. Let me take a little sidestep here. Because one super interesting study we did a couple of years ago, and I don't have the data in front of me, but it was based around building approvals in established suburbs, right? So rather than looking at sort of like greenfield developments, we said, okay, in established suburbs, what is the relationship between building approvals and property price growth? And what we found was an extremely high correlation between building approvals in established suburbs and positive price growth. And I mean extremely strong and extremely positive. Like it was like, if you had an established suburb with basically no new land supply in that suburb, like an established suburb, and there was a high number of building approvals happening in that suburb, then prices would tend to rise sharply. Now, well, that's interesting, but I thought you said there was no available land. Correct. So what are those building approvals? Those building approvals are typically either people knocking down old houses and building new ones that are higher value. So they're like, going into an older suburb, perhaps knocking down an old house, knocking down an old house that's probably an old weatherboard, clunker pile of shit, and building some slick new house, which is going to be worth tons more than the original house. Okay, so necessarily that raises the median, or they're doing major renovations to an established property in that area, which again raises the aggregate value of the properties in that area. And so when you have a high number of building approvals in an established suburb, then you tend to see prices rise sharply. Now, that's a very niche scenario. That doesn't happen everywhere, right? But when you do find those pockets or find those instances, there's a high correlation with price growth. And so could you say, for example, that you should never build a new property? No, right? Because what if that new property is in an established suburb and you've bought some old clunker, you bought the worst house in the best street, that old kind of thing, and you knock that property down and then you build something. Now, there's a strong argument against building things at the moment because of building costs and building completion rates are down. And so this is, again, not an advocation to go start building new stuff, because you introduce so much risk when you go build new things. Anyone who's ever tried to build anything, anyone who's ever built a house or done a renovation knows that it always takes way long. It takes twice as long and costs twice as much. Like it is almost never on time and on budget, right? And you introduce so much supply chain risk and all of this other kind of stuff when you start messing around with that kind of thing. So as someone who has spent plenty of time in construction, it's not actually a smart way of doing things. There's so much risk involved. But just taking that basic premise of like, is there a scenario where building a new property, like, or participating in the build of a new property could be a good idea? Yeah, I mean, there are scenarios for sure. But again, it's very situational.
Yeah. Yeah. A lot of thoughts. No, I was just thinking like what I'm hearing you say is that if your goal is financial, like if your goal is I want to maximize my capital, the market is more important than the asset, right? So again, I'm thinking through like someone that has their deposit, particularly in like a new build scenario, helping people to think through asset allocation and capital allocation like an investor, where if they can go and they might do house and land package or whatever, and then it takes 2 years for that thing to actually come to fruition, and then you may not even see growth for like 5-10 years anyway. But it's like that 2-year period, particularly where you're building, your capital is tied up in that thing where it could be working harder for you in another asset. Correct. So I'm just thinking through like, in that scenario, if your goal is financial gain and growing your capital, it probably does make sense to try to wait a bit or try and find another way to get into a stronger market rather than just jumping into like, okay, I can afford this. I'm going to jump in because I need to own an asset because I understand the K-shaped economy and I understand like I need to get on this side.
Price is not a reason to buy. Price should never be a reason to buy.
Yeah. Yep.
Like
yeah, it's on sale, so I'm going to load up on
price is the worst possible reason you could buy something, right? Price alone. It's cheap, therefore I buy it. It doesn't make any sense at all, right? I was talking to someone the other day who, how do I frame this in a way that is appropriate? So the significant majority of their net worth is in Bitcoin. Mm-hmm. Like the vast majority of their net worth is in Bitcoin. And they have a collection target that they want to own a certain number of Bitcoin. And Bitcoin price has obviously been down lately. And so they were like, I'm going to go buy more Bitcoin because that's going to move them closer to their collection goal because the price is cheap. And they hadn't even considered diversification. They haven't even considered, was that even a smart idea? Should they actually own some other assets as well? Like, does it make sense to go deeper into that pool? So like that's just one example. But price, buying a property, just if you can find an underpriced asset in a great location, then absolutely, like price is a great reason to buy. But the caveat to that is that it has to actually be the right property in the right place at the right time for the right strategy in the first place. Price is downstream of all of those other aspects. So if price is the number one reason that you're going to buy something, then you've sort of got you got your ass about backwards. Basically, it's not going to work out well. Because again, if that was the only measure, then you would be buying some shack in the middle of Upper Conductor West somewhere, and probably doing very poorly for yourself. And so everything is, so you mentioned it's like, is it markets based? Kind of. There's several factors. It's not as binary as like, oh, should I shop on price or markets? Well, actually what you need is you need to start with a strategy, because how would you even know what an appropriate market is, or property type, or strategic direction, or like how would you know what is important to you in order to get you from where you are now to where you want to be? Now, of course, for most people in the early stages of their portfolio, growth is almost always the dominant thing that people need to get. But that's not 100% true 100% of the time. What's actually most important is you analyze the three constraints. You have to understand what constraints either currently exist in your portfolio, credit, capital, cash flow, or which one of those constraints you're going to hit first and why, so that you can select the appropriate assets. That then would dictate, okay, what markets should you look in and what types of assets should you look for in those markets? And so everything's downstream of strategy, market, and asset. Okay. And so it's not as simple as, it's not just as simple as, and so, you definitely have to buy the right property in the right place at the right time. But an example I always use is that there's around 600,000 properties that transact in Australia every year, roughly, round figures. Necessarily, one property is going to be the highest growth property of that year, right? One property will achieve the most growth in that single year. Then there'll be a number two, second most growth property in the whole year. And a number three and a number four, all the way down to number 600,000, right? Which will be negative growth somewhere along there. Now, let's just say, as a thought exercise, that the number one highest growth property that you could have bought in the country was a $2 million 1-bedroom apartment in, or let's make it a $3 million 1-bedroom apartment in Bondi Beach with a 1% rental yield. And so let's say that you tried to buy that. Now, number one, maybe you can't afford it. Maybe you don't have the deposit capability to be able to get into it. Let's just say that you did. Let's say that you had a 10% deposit and you could get into that property. So you had $300,000, and then you've got a then you've got a 2,700,000. Yeah, you got a $2.7 million loan that you need to service. Okay, so let's say you've got a $300,000 deposit. Forget about costs for the point of this exercise. Let's say you got a $300,000 deposit. Then you got a $2.7 million loan you got to service. Can you service that loan? Like, could you even hold that? Number one, could you get that loan? Number two, could you actually afford to service a $2.7 million loan long enough to even realize the growth? And like, it could actually end up, so you could buy the best, you may end up putting yourself into financial ruin just trying to buy the inverted commas best property in the whole market. And that's because you wouldn't have thought about your strategy in the first place. And so the most appropriate property is going to be the most appropriate property for you and your circumstances. And yes, necessarily, if you want to make good investment decisions, you necessarily need to buy the types of assets in the types of markets where there is significant demand, because demand is going to be the driver of how many people want to transact. You could own,
Yep.
you could own the best anything in the world, but if no one wants to buy it, then it doesn't really matter, right? So, like I know people that have got significantly high value assets that on paper are worth millions of dollars, right? Millions of dollars, but they're so niche they can't find a buyer for it. So it's like theoretically worth millions of dollars, but until someone gives them millions of dollars for it, it's not worth anything. And so you have to be able to buy in markets where there's sufficient demand, and demand is going to be driven by jobs, lifestyle, affordability, and capital flows. And that is sort of what's moving the market around. But again, everything's downstream of making sure you have the right strategy. Because again, a portfolio is not a collection of properties, right? A portfolio is a sequence of investments that is designed to get you from where you are now to where you want to be. That is the most important thing. Now, the word sequence in there is just as important as every other word in that sentence, because a sequence implies that there is an order to do things in, which is exactly true, right? The right properties in the right sequence, in the right markets for your strategy. Everything's about that. And that's the most important thing to understand. It's not about houses versus units. It's not about capitals versus regionals. It's not about interest rates. It's not about any of these other things. It's like, where is demand going? Because capital is moving in these markets. The total amount of money in Australia is going up. We've talked about this before. So M3 money supply is going up, rapidly going up. So that means there is more money in circulating in the economy. That money has to go somewhere. It is seeking opportunities. So you need to work out where the money is going to go. And we've said this time and time again, the easiest way to make money is to work out where demand is going, stand in front of it, and open your wallet. And that's effectively what we're talking about doing here. So where is the capital going, and why is the capital going there? How long is it going to go there for? Because of course you don't want to go into markets where capital flows are going to be fleeting. You see that in meme coins in the crypto market, things that are worth nothing, and then they go to the moon. You saw it in GameStop, where a whole bunch of capital moved into the GameStop stock, and then it went up, and then it crashed. Same thing in Darwin. I was going to say,
I'm interested to see what happens in Darwin. Yeah.
I don't think it's going to work out well for a lot of people, right? And so what you need to understand is is there fundamental of investability there as well? Like, what is the now? And this again, the market dynamics are changing so much. As I just pointed out, market cycles are shortening from 7.7 down to 7.7 years down to, what did I say, 4.1 years. By the way, I'm just looking at this data again. The trend, and there's some caveats to this, and we need to do a whole episode on the cycle duration stuff. This is all, subject to a few other elements like measurement periods or whatever. But on average, the cycles are reducing by 2.94 months per calendar year. That's crazy, isn't it? So cycles are getting shorter. Capital is moving faster. Where is it going? Why is it going there? How is it going to cycle through those markets? Charlie just put in the chat, said buy in first home buyer areas. I mean, that's part of it, but actually first home buyers is actually first home owners, right? And so the first home buyer markets, yes, we covered that in a previous episode. There's significant price elasticity that is being caused by the demand of first home buyers entering into markets. But you also have to think about the young urban professionals earning $150,000 a year plus, or maybe household income of maybe $200,000 a year plus, who like living in Sydney but can't afford to buy a home, and they're going to buy a property in an area where they can afford that is also going to be a good place to invest. They're not first home buyers. They're capital allocators. And that capital, the movement of capital flow around the market, is what's driving price gyrations or price movements.
I'm looking at the time because I'm like, we could keep talking about this for hours.
Good.
I was just thinking then about like first home buyers, because similar to what we've kind of already covered about, a lot of people now have this incentive, and it's obviously a good thing. Like, we want to help people to get into homes. Like, it's a good thing morally. But even then, people getting into homes that they can afford based on their savings and the new incentives that have come through,
Yeah.
they're still potentially not buying in the right area. Now, for a lot of people, not thinking
Yeah,
about
for
this
sure.
as a financial asset, a lot of people are just, they're like, I want to buy a home. Like my dream and the Australian dream
Which
is
is
that I
still the
want to
largest,
own
which
a
is still
home.
the largest financial decision anyone's ever going to make. Because, and so like people, sorry
Yeah,
to
people don't think
interrupt you
that way.
there.
No, it's fine. It's
No,
good.
but they do. They do. They just say that they don't. Because if you were to if you said, let's say there was a young family
Yeah,
and they wanted to
everyone
buy a
knows.
home, right? Yeah,
Yeah.
let's say there was a young family and they wanted to buy a home, and that home was, let's just call it $1 million home, right? And they were looking at that home, and if I said to them, "Hey, I guarantee you that in 12 months' time, this property will be worth 20% less," do you think that they would still buy that home for $1 million? Absolutely, they would not. They would not. So you
Yeah.
cannot say that it's not a financial decision, because they would say, "Oh, okay, am I going to wait?
Yeah, it's true.
Maybe I'll buy this home in
It's
12
true.
months when it's 20% less." Now, I obviously
Everyone
couldn't say I guarantee
hopes
that.
everyone hopes it's a good financial decision, but not everyone has the skills or the capabilities to be able to determine, is this a good financial decision or not? So because they don't have that skill set, or that they haven't learnt that because nobody's taught them how to do that, that the default is like, well, I want to get into a home and hopefully it works out.
Well, humans are complex creatures, right? So they're going to look at a home and they're going to say, "Can I imagine me and my family living here? Does this home satisfy? Does this home meet the my needs, firstly? And is its condition and location satisfactory to the vision I have of my life, in line with my current economic circumstances?" Because I know people who have bought homes that they really don't love, in suburbs that they really don't love, but it was the best that they could afford to buy. And so they're like, "Look, it's not perfect and I probably won't live here forever, but I'm happy that I've got a home and that makes me feel safe." Right. And so we're complex creatures. And again, but if I said to those people, that's all well and good, but this property is going to go down by 20% over the next 12 months, they probably wouldn't have bought it. They would have rented it instead. So we have this relationship, like we're complex creatures where we're seeking to satisfy multiple needs at any given point in time. And that's okay. Like, and I think trying to distill it down into these kind of like binary concepts isn't enough to explain the complex nature of us as humans. And this is the whole thing about like economics. Like economists will try and tell you that economics is a science, but it's actually a moral philosophy, right? Like science is like gravity. Okay, right? If I pick something up and drop it, gravity is gonna
the math says it will fall this way. Yep.
Yeah, exactly. It's the science, and it's provable and everything like that. Whereas if you take $1 million and split it in half, right, and give it to $500,000 to two different people, you don't have any idea how they're going to react. You don't know what the second order effects of that are going to be. And you could do that experiment 100 times with 100 different pairs of people, right? And you could have different results each time. And this is why economics is a moral philosophy, not a science, not a mathematical science, because actually humans are complex. How they behave given various stimuli in various environments is going to differ based on so many different environmental factors. Where were they brought up? What is their relationship with the environment they're in? What have they heard recently? Did they have a bias towards fear? What's their health like? Like if someone's of poor health, they're more likely to feel stress. And so they could have the exact same economic upbringing. You could have two people that are identical twins, same upbringing, same everything. One of them has cancer, one of them is in perfect health. Given both $500,000, they're going to react differently, right? So many things about the human condition don't match with like some basic binary idea of like, well, okay, 1 + 1 = 2. It's like, no, 1 + 1 = a complex human being. Okay, fine, got it. Okay, we have no idea what's going to happen. All we can do is we can think deeply about what are the human needs. How are people going to feel in different circumstances? What does people's behavior teach us about the environment we're in? And how can we then adapt to that? I think it's really interesting. I want to talk about something else, given that this has become like very property centric. I know we're about to go over time, but I also want to talk about the geopolitical situation as well. We don't have much time, but it's a worthy topic, because a lot of people, there's obviously, not to get too, obviously it's a sensitive topic. There's between everything that's going on in the Middle East, the US, Europe, all that kind of stuff. There's a lot of geopolitical tension at the moment.
Yep.
And again, this is noise that people hear and feel, and then it causes them to flee, fight, or freeze, right? And in most cases, it's freeze, right? And they're like, oh my God, what's happening? The thing that I would point out about that is that Australia has been and continues to be seen as a safe haven. So just in the same way that gold is seen as a safe haven, and all you need to do is look at the gold chart and see how people have been reacting to gold over the last, say, 12 months. It's been on a tear because people see gold as a safe haven asset in times of crisis. Now, Australia is seen as a safe haven country. We have a stable economy. We have good rule of law, English speaking, generally, or certainly the perception of a lot of economic prosperity and a lot of economic opportunity. We are geographically separated from a lot of the conflict that can happen in the world. We're politically separated. We're not economically big enough to be roped into all these things. The EU is, China is, the US is. And so you have these like larger economic, Russia is. Australia is not economically large enough to be a major geopolitical player. We are not geographically central enough to be accidentally embroiled in a lot of these conflicts. And so what that actually translates to is we become a little like New Zealand's quite similar as well, by the way. We are seen as a safe place for people to go. And that actually drives migration demand, which is something we've been talking about for a long period of time, that as the world becomes increasingly uncertain and as economies and nations fail for a variety of different reasons over time, or if they're experiencing significant amounts of conflict, people will want to move to Australia. With that comes obviously population. That's one. And more population means more demand on real estate. And number two, they bring capital with them. They'll bring their savings, whatever that is. That capital comes into the country. It's net new capital that comes into the market. So net new capital plus net new people equals net new demand for goods, services, and assets in the country, and typically real estate. And so I'm not trying to like monetize the situation in the Middle East, but I think it's very important to really just think about like, what does this mean? Like, is this a moment to be scared, or is this a moment to recognize that Australia is not really involved? And a lot of people around the world are probably asking themselves, where can I go? Where can I go where I don't have to feel unsafe and unsure, about me, my family, my money, my capital, like all that kind of stuff. Like Australia has low perceived corruption, low perceived crime, high perceived prosperity. I say perceived because not all these things are absolutely true, but it's certainly how people think about them. And so that creates demand globally for people to come to Australia. And again, that brings people, that brings capital, that brings demand for the markets. And until that changes, then, I only see, greater social unrest in other parts of the world is net positive for Australia. It's net negative for the world. So let me just be really clear about that. I'm not a warmonger. I don't think it's, I don't think it's good. I think there's a lot of stuff that's going on in the world which I don't love at a human level. But it doesn't change the fact that Australia is increasingly seen as a safe place to be, and that creates opportunities within Australia. So I would just say, for anyone who's kind of sitting on the fence going, oh my God, there's missiles flying around all over the place. What does this mean? I'm scared. And should I sit out of the market? I would just say, just take a moment and step back and think about where is Australia positioned in all this, and what's the likely scenario? The likely scenario is that more people are going to want to come to Australia, both now and into the future. And what does that mean? That means that more people are going to want to buy properties or to rent properties. It creates more housing demand generally, and they bring capital with them. That capital translates into investments in assets. So that's just a point that I wanted to make on that.
No, it's a good addition to get in, because it's like, it's not, again, we're not saying that this is a good thing. It's not inherently a good thing. It's a bad thing. But the reality of just how it can flow through to the economy, that reality doesn't change whether it's a good thing or a bad thing. Like, there's no good or bad in how the pieces work together. It's just how the machine runs, right? And so we're just trying to point out that this is likely how it's going to impact Australian real estate, and you have the right to make the decisions that you need to make for you and your family at this point in time and at any point in time. So It's not great stuff that's happening, but that's where we're at right now.
Yeah.
Yep.
Totally. And don't get caught up in the what ifs, is what I would say. Because a lot of this stuff, all this noise, it's the what ifs. You know, like it's all the what ifs. Like what if this becomes World War III? What if CGT rules get put in place? What if?
Yep.
What if? The thing about what ifs is there's an infinite supply of what ifs, but there's a finite supply of facts. And so if you bias towards living in reality, then look, I spend a disproportionate amount of my time thinking about all of the potential scenarios in the world, right? That's how I spend most of my time where I'm not actively engaged in working or something like that, is I'm thinking about where is the world going? How are things changing? Like, what are all of the various scenarios? So I'm absolutely not saying just put your blinkers on and stare at your feet and look at the ground and only exist in your present. You should, necessarily be taking it all in, but also recognize that it's all potential, right? And that potential has to collapse. You know, the wave function has to collapse in order for that potential to become reality. And so being aware and understanding of it is important. But acting on, you need to be careful to act appropriately and not freeze out of fear. So that's what I would say.
Yep.
Cool. Awesome.
Cool.
Well, good episode today, Gabby. I reckon we covered a lot of ground.
We did. No, that was fun. I like being able to just pull ideas apart with you, because it's why not do it? Why not do it on camera and not just at our dining table? Yeah, we covered a lot. If there's anything that we touched on in this episode, firstly, if you've made it this far into this episode, thank you. We appreciate you. Hopefully you've gotten value and this was interesting to you. If there's anything that we kind of loosely touched on, or maybe like we mentioned a couple of studies then that we've done in the team around cycles and things, if there's anything that was like, oh, that sounds interesting and you would want us to go deeper on in a whole episode, chuck a comment on YouTube, because we do want to know, because every week, every fortnight, Goose and I need to come up with a topic that we want to share. Obviously there's a lot happening in the world, so it's not too difficult to find things to comment on, but I want to know if there's specific things that you want us to spend an hour or 90 minutes really digging into, doing research into, to find that and bring that to you and share that. Leave a comment
or if you prefer these type of episodes as well, by the way.
Yeah,
because like it's one thing for us to go like do a whole bunch of research and come up with a whole bunch of charts and stuff, and that's fun and interesting. It's also a lot of hard work. And I actually question whether like there's a time and a place for that kind of stuff. But also I think episodes like this, where we really get to like pull apart the thinking around stuff, may actually be more beneficial for people overall. And I know there was some like really good follow-up questions that we've received around the episode we did last time around the K-shaped economy. And it's like, okay, all well and good, but like, what do we do? That was actually one of the things I wanted to get to today that we didn't get to. It's like, well, what do we do? Okay, great. Well, I actually have put a lot of thought into that. What can you do? How do you get ahead? All that kind of stuff. So I think there's a lot we can take out of that. We'll get better at keeping up with the YouTube comments. But to Gabby's point, like if you enjoyed this, if you have follow-on questions, like leave comments on YouTube, and that can help us inform how we show up to these episodes so we can add the most amount of value. Our number one objective with this is really just how to create as much value for all of you who are listening as possible. Yeah. And the one request is if you got value out of this, do all the things, like, subscribe or whatever, but actually share it with someone. Like if you think there's something useful in here, share it with somebody else so they can hopefully grow as well.
Love it.
Awesome. Thanks, guys.
Thank you.
See you in the next one.
See ya.
Bye.